We've really just started the process of defining costing. Now we get to dive into it. And we'll start off by talking about job costing. But before we talk about job costing, we'll do a little more definition of costing systems and what they are. How many of you have bought a couch? Not from IKEA. So when you buy a couch, a nice couch, how long does it take to get it? Months, right? I haven't bought one in a few years, but I assume it's still months. Why is that? Because they custom make it. You want a certain fabric and a certain this and that, and they custom make it. These couch makers are job costers. They custom make your couch for you. So if you have a visual image as you think about job costing, think about making a couch. A job shop, yes. Disney makes a movie. It takes them 2 years. That's a job. If you're joining a service company, which many of you are, either in accounting or in consulting, it doesn't matter, your audit is a job. Costs have to be accumulated for that job to figure out whether that was a successful, profitable audit or not. That's a job. So these are all job shops. Service organizations tend to be job shops. Okay? So we'll start off, we'll talk about types of costing systems. We'll talk about the strategic role of product costing. We'll talk specifically about job costing, how you apply factory overhead in a job costing environment. And we'll talk a little bit about journalizing. Here's one of the cases we'll actually talk about journals. And I'll try not to frown through it. And then we'll talk about the service industry, because, as I said, this is the New York metropolitan area. It's service-based. Many of you will be working for a service-type company. Okay, so a costing system. Every company has a costing system. Product costing refers to the process of assigning costs, both direct and indirect costs, to a product or a service. Direct costs are traced directly, because you'll see in a job shop how easy that is to do. Indirect costs are allocated, this we just said. Every company will choose a different model based upon what type of business they're in. So it's based upon the industry and the product or the service they have, their strategy, and we'll see how the two basic strategy types normally bring different kind of costing systems into play. And then, as we just talked about at the end of the last chapter, you have to think about the cost of developing the system. Is it worth? Is there enough value in certain types of costing systems to actually implement them? And in particular, we'll be thinking about the cost of activity-based costing as an example. So when you're coming up with your costing system, you're making three primary decisions. How are you going to accumulate your costs? Is it through job costing or process costing? Kind of the two ends of the spectrum, or something in between. Then how are you going to measure those costs? Are you going to use actual costs, normal, or standard costs? And we'll talk about actual and normal today. We won't talk about standards till later in the semester. Standard costing till later in the semester. And then you need to decide how you're going to assign your overhead. Whether it's volume-based, which is the classical way of doing it, or activity-based, which is the modern way of doing it. So each costing system will incorporate a decision on these three criteria. So an organization can say they're a job costing shop with normalized costs and activity-based costing. That could be a model that a specific company chooses. And to some degree, it's based upon your strategy. So if you're a cost leader, what does that tell you about your products? They're going to be cheap, for sure. Are they going to be unique and different? They're not unique and different. So they're likely to be developed via a process of some kind. You'll probably use something like standard costing. You could use normal costing. And you would want to use activity-based costing. That's because products are homogeneous and produced in large production runs. That's why it's process costing. And then standard costing, activity-based costing allow you to really, really focus in on the costs and where your costs are, and what are the value-added processes and what are the non-value-added processes, and where are the processes that are running a little bit out of control and the ones that are not running out of control. So by using this costing methodology, you'll be able to manage your costs much more tightly. And clearly, where you're trying to succeed and compete in this kind of environment, you want to manage your costs as well as possible. Okay? That's kind of one end of the spectrum. A low-volume, diversified firm that has a differentiation strategy. The opposite side, you're going to have a lot of distinct products because you're going to customize them. So it's more likely a job shop. And you want to trace your costs through the job. And then you get to make a decision on whether or not you'll use standard costing or normal costing, probably not actual costing, and whether it's volume-based or activity-based. So every company is going to have a different model for accumulating the costs. Okay, so let's think of the three questions you need to answer. First is about cost accumulation. Are you job costing or process costing? In job costing, costs are assigned to specific jobs. And it's an appropriate model when costs can be readily identified with a customer, job, or project. So you have to be able to identify a cost specifically in order to use job costing. And it's generally used for firms that have custom products. That's what we said. Think of the couch. And for professional services firms, because of the projects. You know, it's really a job or a project in a professional services firm. On the other hand, process costing tends to be in larger companies that produce homogeneous products. So in fact, an auto company, which is right in the middle of our 5 steps, from Disney all the way down to Exxon, would probably use process costing. So if you look at job costing, some companies that would be doing that: construction, printing, where you're printing a specific item, specialized equipment manufacturing. Think Boeing, think Caterpillar. Shipbuilding, medical services, our furniture company, and then service companies. Process costers, chemical companies, bottling companies, plastics, food products, paper products, etc. You can see what they have in common. They're just going through a flow. And that's what a process costing company does. So that's your first question. The second question is cost measurement. Actual, normal, or standard. Actual, that's rarely used because it's not timely. So for actual costing, you use the actual cost of your direct materials, the actual cost of your direct labor, and the actual cost of your overhead. When do you get the actual cost of your overhead? After it's done. It's late. It's too late to really do anything about it.
And the actual cost of materials would be either by
It's actually the cost of purchasing those materials for that job. So it's not.
if you have some stuff in
Then it's whatever you use. So it's not timely. It's the actual cost. And what do we know about overhead? I mean, you've heard of overhead before this class, I'm sure. What do we know about overhead? It's fixed. It's indirect. It's probably less controllable than some others, and so you're going to be assigned overhead that may or may not be fair. Let's say your company decides to drop another product line, so your overhead doubles. You can't manage that. You just got to you were just assigned a value at the end of the period. So for the most part, actual costing is not used in production, but it's possible to do. The model that we'll talk about today is normal costing, where direct materials and direct labor are still charged directly as used, but overhead is based upon a predetermined amount. A term that you'll see us use is the denominator activity, and we'll get into that, which essentially says, let's say whatever your driver is, whatever your cost driver, let's say it's direct labor hours, there's an expectation for how many direct labor hours are supposed to be used, and that will drive the cost per unit. And we'll get into this in more detail. But you're able to determine ahead of time what your allocation of overhead will be. It's not after the fact, because you're deriving it off of some budgets and estimates. At the end of the year, you need to fix that, in case, because it's never going to be exact, right? It's based upon an estimate. And at the end of the year, every once in a while you get lucky, but more often than not, it will be off. And if you've done a good job, it's just off a little bit. If you've done a bad job, then it's way off. And we'll hold off on talking about standard costing for another time, except to say that standard costs are costs a firm should attain under efficient operating conditions. And it's a strong way of controlling your costs. So, in a nutshell, as you look at actual, normal, and standard costing, actual is using the actuals for all three categories. Normal uses the actual for direct materials and direct labor, and then applies an overhead based upon an expected level of driver. And standard uses standards for all three. So, different approaches. Okay, those are the first two questions to answer. The third one is, do we use volume-based assignment or activity-based assignment? Volume-based allocates based upon drivers, such as direct labor hours, direct labor costs, or machine hours. And that assumes that the overhead costs are directly related to the usage of these drivers and ultimately to the volume of output. And there are some inherent flaws with this model, but in many companies, it's fine. It's important to say, just because it's not as accurate as activity-based costing doesn't mean that it's not acceptable. Activity-based costing allocates based on some cause and effect criteria. You have multiple cost drivers, different cost drivers for different activities in the value chain. Some of those cost drivers will be volume-based, some will not be. It results in a more accurate allocation. It comes with a cost. And we'll talk about that in a lot more detail. Okay, so we know this. We're now going to shift into talking about job costing in particular. So we're into the job shops. So any one of you who have projects, companies that are job companies in your opinion, this relates to you. Okay, so job costing starts with a job cost sheet. This job costing sheet accumulates all the costs associated with the job. And again, it doesn't have to just be a job. It could be a customer, it could be a project, a client, however you want to look at it. It records the direct materials and direct labor, and then the factory overhead that's been applied. The job cost sheet is opened up at the beginning of the job and continues until its end, obviously. As the job proceeds, costs are accumulated, and upon completion, overhead is allocated. Okay, so here's an example of a job cost sheet. Brings in direct materials, direct labor, and then factory overhead based upon, in this case, direct labor hours. Notice this 100 matches that 100 there. And you're able to come up with the total cost, somewhat approximated, for that job. And if you were to add up all your job costing sheets in a company for all the jobs they're doing, that should match how much you have in work in process. Let's talk about the flow of the three categories of costs in a job shop. Okay, direct materials start on a materials inventory. How many of you have heard of a bill of materials somewhere along the line? A bill of materials. Think of this as everything it takes to build a couch. All the different parts are listed on a single sheet. So Thomasville, which is a couch company, knows every single part associated with building a couch, customized by the order. You know, how many pieces of 2x4, how many springs, etc. So a bill of materials lists everything out for that project. Using a materials requisition, you then ask for those supplies that you need from the bill of materials, and you're charged for them. Either you're going to get them from the warehouse because it's in inventory, or you have to actually go out and buy it. These costs become part of work in process as soon as they're transferred in. And then there are indirect materials as well. Rags, I don't know, oil, grease, things that are not specific to a specific couch, but you might need in the factory so you can get your job done. They don't go directly. They will be allocated into overhead. Those would be indirect materials. So this is a bill of materials for a couch. The pieces you need, a part number, the number of them. Quite often the bill of materials is driven from engineering. So in a, you know, if General Electric were making jet engines, engineering would just figure out what needs to be put into a jet engine and would produce a bill of materials as part of their their product, so that production knows what it takes to build a jet engine. And it would look something like this, and this defines what your direct materials cost should be. A materials requisition is actually the actual request for an item from that bill of materials. That would then, once you've requested it and you received it, it would go into work in process. Okay, shifting over to direct labor. So you'll have timesheets, and you all are going to, those of you who are moving on to accounting firms, will become very close with your timesheets. You'll see. It shows the amount of time you've worked on a specific job. Your pay rate, expenses as well, particularly in the business that you'll be in. Expenses are an appreciable part of the cost. It matters. It may not show your pay rate, but there's going to be a billing rate, and we'll talk about it soon. But your billing rate does not approximate how much you're getting paid. There's a lot built into that billing rate. And so, as an individual associates their time with specific projects or specific jobs, those costs are then applied to those jobs. Indirect labor, like kind of the partners, kind of overhead, are recorded as overhead and eventually get assigned projects. Some partner time in accounting firms is actually working on a job, but a lot of it is not. And their cost is in your billing rate. So, I mean, this is an example of a time ticket. I'm going to assume that, quite a few of these time tickets are now online. A lot more. A lot easier to work within a paper-based time ticket. Okay, factory overhead. Talking about actual, normal, and standard. And with actual, you track the overhead in some fashion, and then you transfer it into work in process and finished goods in some amount incurred. Won't go into that in too much detail. Under normal allocation, overhead is applied to a job using the overhead rate. So this avoids month-to-month fluctuations due to volume differences. So you know pretty much how much your overhead will be each month. Now, it could be changed. During the course of the year, you could see, well, we estimated in January and we were way off. You can then fix things as appropriate. But you don't necessarily fix it each month as you go through the process. Okay, so the key to assigning overhead is to figure out this denominator activity level. So the first step will be to figure out what you believe the total overhead for the period will be. And let's think of about a year as the period. So it's not a month, it's a year. Then you determine the cost drivers that will be used to apply that overhead to production. Jeez. Excuse me. I don't even know what that is. Then so then you figure out what driver you'll use. Quite often it's direct labor hours. You'll figure out the total expected activity level for that driver. We expect to have 100,000 hours of direct labor this year. And then for each cost pool, you compute the overhead rate by dividing the estimated total overhead by the labor hours, let's say. So again, if you had expected $1 million of overhead and 100,000 hours, $1 million of overhead and 100,000 hours of direct labor, then it's $10 per unit of direct labor would be your cost. Okay, so if you think of that back, this is an equation. This is your total expected overhead for the year. This is the total level of usage for whatever your cost driver is. I've been using direct labor as an example, but it could be machine hours, it could be number of sets, it could be a wide variety of different drivers. And you would then get your overhead rate, which is some dollar amount per some unit of driver. Then in a given month, as you realize exactly how much of that driver you actually use, let's say you've actually used 15,000 direct labor hours at $10 an hour, your overhead for that period would be $150,000. So it's based upon your actual usage of the direct labor in a period. Which is what we show here. You pre-calculate your rate, and then you use your actual activity, and DLH is just direct labor hours, and that is your overhead assignment. Now, since your actual activity is probably not going to hit budget exactly, multiplying your rate times your actual will probably not give you the exact amount of your overhead costs for the year. So at the end of the year, you have to do something to correct that. But you don't have to do that each month. Which is what I just said. If you've applied more than the actual, and the applied means this times this is the applied. If that number is greater at the end of the year than the actual, not a surprise, the excess is called over-applied. If it's less than, it's under-applied. And the key is you want to do a good enough job at the beginning of the year so that the differences are small and don't matter. That's the art of cost accounting. Okay. Let's see how we're doing here. Just take 5 minutes to answer these 3 questions with a neighbor. This isn't your project team. 1, companies are moving away from direct labor hours to machine hours as the cost driver. Why do you think that is? And then a couple of relatively basic math problems just to make sure you got it. volunteer for question 2 and question 3 on the board? Okay, Alejandro, question 2. Give you a chance to earn some of those points. Someone for question 3? Thanks, John. Oh, sorry. Oh, that's your fault. That's your thing. That's okay. We'll work it out. Yes.
Did they put 590,000 where it was 14, or did they put more?
The 590. And then, but at the end of the year, they figure it out. Right. Sure. We'll talk about that. It'll be, well, if they produced 59 and they sold 60, where did that other 1,000 come from? The previous year. So it would have been worked on. It would have been charged the previous year. Well, we'll talk about it, but you ignore it. Only one of those two numbers is relevant for this process. Okay. And it's production, not sales. Okay. Okay. Let's answer question number 1. So companies are moving away from direct labor hours to machine hours as a cost driver for overhead. Why do you think that is? More accurate. Exactly. Which makes it more accurate. That, you know, we're in a world of technology now where technology has more and more gotten rid of the need for labor in the production of even jobs. Not so much in service industry. That's still going to be direct labor hour driven. Okay, Alejandro, could you walk us through here? Okay. Pretty straightforward. This is just to get you comfortable with the calculating the rate. One is not better than the other. You have to have a lot more context for the question to know which one is better. Okay, question number 3. So you ask. Yeah, not necessarily. So your actual overhead is $613, and your overhead rate was $10 per unit. You sold 60,000. You produced 59,000. Was it underapplied or overapplied? Well, you did it great. You just used the wrong term at the end. Excellent. It's underapplied. You applied 59,000 because it was $10 an hour and 5. You applied, excuse me, 590,000. $10 an hour, 59,000 hours. That's how much you applied. But actually, the cost of your overhead when you look back at the end of the year was $613,000, which means you didn't apply $23,000 worth of overhead. So you underapplied your overhead, and you need to do something to get it fully applied. Okay? And you know, a question that came up, and it should have come up as you're doing this problem, to use the 59,000 or the 60,000. And the correct answer is the 59,000. That it's about production, how much you produced. But how is this 60,000? What's that missing 1,000? What's that all about? Inventory. It was from the previous year, and you got to sell it this year. So it was accounted for last year. Okay? Yes, sir. I'm glad you asked. That's exactly where we're going, right from here. So when you have underapplied, I'm going to tell you the very brief answer now, then we'll talk about it a little bit more in about 4 slides. You have to, at the end of the year, put it into the appropriate journal entry, whether it's cost of goods sold or wherever you're going to put it. And so you actually have to make up for that difference at the end of the year. So that 23,000 needs to go into the costs. You can't just let this hang. But it's important to know that it's different than what's been applied, and so you account for it separately. Because maybe you don't want to judge the manager of the factory floor for the 613. You want to judge him or her on the 590. But you do have to account for it in the cost. So when we think about the overall flow, this is just a summary. Starts off with some kind of a production order. You use material requisitions and time sheets to get your direct materials and direct labor costs in. Then you apply your manufacturing overhead. From the perspective of how it's accounted for, they all start off in work in process inventory. They moved over to finished goods, cost of goods sold, and they eventually get into the income statement. A little more detail on this. Direct materials. You purchase the materials or you get them out of inventory. They go into work in process. Indirect materials that are requested do not go into work in process. They go into overhead. Labor will look the same. Direct labor goes into work in process. Indirect labor goes into overhead. You then take your overhead and you get your overhead into work in process through your overhead application. Now you've accumulated your direct and indirect costs in work in process. You then take those costs and you move them on to finished goods and cost of goods sold. And then you have to dispose of your under or over allocation, which is the question. So this is somewhat temporary. This number is whatever you applied until you figure out the real number. And there are two ways to adjust. You can adjust directly to cost of goods sold. You would just add, since you've under-applied here, you would just add the 23,000 directly to cost of goods sold to make it right, but as a separate title called under-applied overhead. Or you can prorate it based upon the size of each of the buckets between work in process, finished goods, and cost of goods sold. So you have the option. True. Similarly, if let's say you're selling a jet engine and it took more direct labor than you expected, you're not going to, unless it was some kind of a cost plus contract, you're not going to get that back from a customer either, right? You make the deal up front. That's the normal way to do business, and then you try to do your best to match, to meet your targets on your costs. So yes, you're not going to get it back from your customer. That's why you have to do a good job of estimating up front what you believe your overhead costs will be for the next year. That's an important process. Any other questions on that? Okay, I think this just summarizes what I just said. It's under-applied. You have two different alternatives. Both of them are acceptable. Same thing for over-applied. Okay, service industries. As I said, job costing is used extensively in service industries. Your cost object is a client, a customer, a contract, a project, rather than a job. And the major difference is direct materials. There's very little direct materials in the service industry. It's a small part of the total cost. If any. There are some indirect materials, the brick and mortar of the office, Ernst & Young's office, that has to be allocated out, supplies, etc. But you're really focusing on direct labor. And overhead is driven by direct labor hours in that case. And in fact, overhead is factored into the billing rate that you're billing to your customers. So, as you look at how much you're being billed out as a first-year person at an auditing firm compared to how much you're earning, and you're getting frustrated, why aren't I getting that money? Know that billing rate factors in a lot. In a retail store, it could be whatever, but quite often the cost object is the location. So, Willowbrook Macy's will be a cost object. So, service industries really focus on direct labor. Okay, hybrid costing, also called operations costing, uses both job costing techniques and process costing techniques, of which we haven't talked about process costing yet. Uses job costing for direct materials. So think about Ford Motor building a car. Use the direct materials for each car. And process costing for conversion costs. Anybody remember what conversion costs are? Yes. And only one other thing. Overhead. Conversion costs are direct labor plus overhead. The cost of converting raw materials into a finished good. Think of it that way. So hybrid costing is a possible scenario. So if you think about a car company, they may have a low-end car and a high-end car. They use less expensive materials for the low-end car than for the high-end car, but ultimately the fabrication, the labor and the overhead is approximately the same. It doesn't matter what you're using, but it still has to be screwed in the same way. It makes sense to have different direct materials costs for the different vehicles and just have a process flow for the direct labor. Because somebody on the line is not going to measure, I just put in 34 seconds to screw in that bolt for this car, 34 seconds again. They just know they've been screwing a lot of bolts during the day. So it's common in a lot of industries. It doesn't say here auto, but it would be auto as well. Think about jewelry manufacturing. You might make jewelry out of silver, you might make it out of gold. The actual design could be the same for those two sets of earrings, but the cost of the direct materials is very different. Okay, spoilage, rework, and scrap, which I'll just briefly discuss. Spoilage refers to units that must be discarded or sold for disposal value because they just aren't up to your standard. And spoilage can be broken down into normal spoilage and abnormal spoilage. You expect spoilage. If you're building a couch and you're getting all these 2x4s, you only need, you get an 8-foot long 2x4, you only need 7.5 feet. That other half a foot is spoilage. It can be sold for, if it can't be used as another part, it could be just sold for sawdust or whatever it's going to be sold for. If there's spoilage which can be specific to a job, that half a foot of wasted wood, that cost is assigned to the job. If it's common spoilage, it can't be assigned to one job or another. It's included as factory overhead. And that's for normal spoilage. That's expected to happen as a byproduct of doing business. And then you would spread out the costs of spoilage. For the common spoilage, it would be spread out across all your jobs. Then there's abnormal spoilage. Maybe you're a food processing company and your refrigeration unit broke down. So that's an excess over expected, and you don't really want to charge that to a specific product because it's not fair to that product, right? The manager of that product shouldn't get that cost. And so it will be accounted for separately as a loss from abnormal spoilage. So normal spoilage is just part of the overhead and or specific job materials, and abnormal spoilage is accounted for separately. Rework. This is a situation where maybe you're producing electronics equipment, and towards the end of the process you have to test to make sure it's going to work. And you find out, hey, it's not perfect. You need to go back and do more work on it to get it ready for sale. And again, there's normal and abnormal. If it's normal, it's just charged to the product. If it's same thing, it's either common or individual. And abnormal will have its own category loss from abnormal rework. And scrap has no value. And again, that's where it goes.